Welcome to the Daily Update. This is Being Prepared Thursday, July 21st, where we'll look at the action in the market today and then see how things look for Friday, July 22nd. And I'm still in a yet different location to record to see if the sound's any better. And I also have a very rambunctious cat who may try to interfere things as I try to record this. So let's go back and talk about what happened. It was a pretty positive day. We saw 3 up days now in a row. Technical charts are showing a lot of improvement. And we may have overdone it in the short term. Some indicators that we have are suggesting that maybe we've gone up too far too fast. We might be in for some sideways action or possibly a little bit of a retreat. But nonetheless, we can still go higher from here. The market can always do anything. But according to our charts and what has usually happened in the past, we might see things slow down a little bit, or there is more room to run to the upside. So it's kind of hard to tell with these things sometimes, picking out overbought and oversold conditions with any real accuracy. So right at the open, we had a little bit of a lower open and then selling started. And this is what I thought at the beginning anyway, well, maybe we're going to pull back today. We went all the way down to S1 at 39.30. As the day went on, we rebounded and we went from S1 all the way up to R1 at 39.82. Buying continued and pushed prices even above R1, but we didn't quite get to R2. That's at 4,004. And to get over the 4,000 level, yeah, it's not that big of a deal necessarily from a technical analysis standpoint, but it's a big psychological deal. And the financial media loves to talk about it. And people like to base things around whole numbers like that. So we might need a little bit more of a push to actually get us above 4,000. Going into the close, we closed right at the high. So that is pretty positive. We were up 0.99%, not quite a percent. Volume was actually above average. So that could be a little bit encouraging. We see an up day on an increase in volume. Okay, maybe some folks are starting to take this for real. The technicals, they're looking much, much better. And I'll show you all the charts as we go through that. We still have this big problem with inflation and interest rates. That's what the stock market is concerned with the most, because that produces growth concerns. We have a whole list of geopolitical concerns. Earnings are starting to come out, and that can have an influence on the market, either positive or negative. And then the debate, recession fears. Are we in a recession? Are we not? So what are some comments that we can make based on this? As I stated earlier, this is the 3rd up day that we've had. We're seeing some pretty solid gains, and we're seeing our charts really improve. One thing that I will point out as we go through the charts, the new highs and new lows, they're starting to turn down. So that is a bit concerning. This is when we open the hood and look inside at the engine to see how are things performing. And when we see prices really start to go up, and a lot of our charts show a lot of improvement, but the new highs, new lows, they're starting to turn down. That is a little bit of a worry, but yet there's always something to worry about. It's never black and white with the stock market. So we just want to keep an eye on this. The sector rotation, it's still holding up. We're still advancing. It's looking like that is a viable scenario. So some of you may have already nibbled a little bit, got in a while back when we started to see this. Some of you, if we have up days, you might continue to add to those positions, but it looks like even though the ADX is not trending right now, it looks like it could turn into a trend if we get some legs behind this. Now, if we start to pull back and go down, then things might end up chopping a lot more. And a lot of the more clear picture that we're seeing right now could turn a bit hazy again. And on Thursday, we also had growth. Continues to perform well. And I have another screenshot to show you, and it is strong. Even when we were down at the open, growth was down a lot less. In fact, it was even positive right after the open. What I show you is just the closing value. The 10 to the 5 and the 10 to the 2 continue to be inverted. So that's suggesting that there might be a recession. The Bank of Japan ended up lowering its 2022 GDP growth forecast. It had been at 2.9%. Well, they lowered it to 2.4%. And then the European Central Banks, or ECB, they announced a 50 basis point increase. So just like the Fed is going to do next week, well, the European Central Bank ended up doing it this week. And that was stronger than they had expected. We had jobless claims come out, and this is kind of interesting. We're starting to see a little bit of a trend here. They expected it to be at 240,000. Well, they came in stronger than expected or higher than expected. And that's negative. That means more and more people are filing for first-time unemployment benefits. So that might start to nibble at the employment picture that so far has been holding up quite well. Then we had the Philadelphia Fed Index. They expected it to come in down 1.2. Well, it came down 12.3. So that was much weaker than expected. The leading economic index or leading economic indicator, they expected it to be down 0.5%. It came in at down 0.8%. So all of these are showing some weakness in the economy. Now, from one side of the issue, that's helping things because there's been a real problem or a concern that the Fed might raise interest rates a full percentage point at next week's meeting. With these weaker economic reports that we're seeing, that is starting to lessen. And I have the updated Fed Watch chart to show you that. Our trend is not trending right now. We're below 20 with the ADX, but we do have a positive bias and positive momentum. However, as I said, we might be a little extended right now. So to see some kind of a pullback would not necessarily be a surprise. Let's go back and look at the day's session. Sentiment is really coming up now. We're at 42. We're getting almost back to the neutral area. And here's just showing how we've come out from below 25 and we're really starting to climb as prices continue to go higher. We have the American Association of Individual Investors. They're still pretty pessimistic, but they're not extreme pessimistic like they were before. And when we were extreme, that can be positive for the market. And we're seeing a bit of a bounce when all of them become, I should say all of us, become very pessimistic as a whole. Here are some Isabel net charts. This one's a little strange. I'm not really sure what AA means. Net percent of AA, is it active assets? Is it American Airlines? I'm not really sure, but there's really no legend here to tell me or key that I can kind of read into this. But a lot of these folks are saying that they're still overweight in equities. And a lot of people are. They get into mutual funds or they get into stocks and they have their own portfolio and they ride it out no matter what's happening, because there's this idea that eventually things will turn around. And that's true. About 75%, now that's a very loose figure, of the time, if you go all the way back to 1900, well over 100 years, about 75% or so of the time, the market does go up. It's that 25% that can really kill people and can really cause a lot of stress and can really wreak havoc on portfolios. But this is just showing that most people, according to this, are still overweight when it comes to equities, meaning stocks. This is the CAPE, and I show this every week in the weekly video. This is Robert Shiller, and he's come out with his own way to measure the PE ratio. And he, according to this, we are still overvalued. Where this dotted line, this is the historical average. This is around where we should be. Well, we've been way above that for a long time. Going back, my goodness, 10, 11 years, we've been overvalued. And we're starting to come down, but on this basis, and this looks back, this uses the trailing 12 months to calculate the PE. It doesn't look forward. And so we're still overvalued, according to his calculations. And then we have a thing called the diffusion index. This is just showing if you take all the different yield curves together, what is the likelihood of a recession? And we're up between 40 and 50%. You can see other times when we spiked up a lot more than this. So this is suggesting, according to this, that yeah, there's a chance of a recession and we may hit a recession, but it's not as high when it comes to probabilities as it has been in the past. This is showing after we have 90% up days, and we've had a couple of those this week. Is that good looking forward, or is it bad? And I've seen studies that go both ways, that we need a 90% down day before we can really get set to go higher. That produces more of a washout situation, where sometimes a 90% up day, that could signal a market top. I've seen statistics to support that. Well, looking at this study, these are the NYSE. This is not the S&P, but the NYSE 90% up days. And we've had a few of those. And if you look back at other times, a lot of times that will mark the end of a decline and sometimes the start of a real rally from there. These are the equity flows. This is updated about once a week, showing that most participants are in the US market. That's the dark blue line. We have orange, which is international. Let's see, funds with a global mandate. Okay, they have to invest all over the world. And then this kind of purple line here, I believe that's Japan. And then the darker purple line is emerging markets. A lot of people really enjoy investing in that. Then the purple line that's right about on the zero here, that's Japan, where Japan's really having some trouble. And the green line is Europe. They're having a lot of trouble now too, especially with inflation. And it just says investors no longer expect higher bond yields. Well, maybe that means that's what's going to happen. Or if we can turn around based on price and really start to go up, that will keep pushing bond yields down. I will say one thing, those that are in the markets, in the bond market, and I've said this before, they tend to be more educated. They tend to be smarter. They tend to understand what's going on a little better than a lot of stock investors do. So that's why we watch the bond market, because we can get some clues from that. Because to see rates really come down quickly in a high inflationary environment, that's not normal. Maybe that means that the bond market is saying, okay, maybe inflation's going to get under control. And so we're going to start buying. That's going to push yields down. And that could really help the overall picture. They could also be wrong, or just not looking at things that are realistic at this time. So again, we want to be suspicious, but we want to look at things the best we can to try to get some insight. This is the skew index put out by the Chicago Board's options exchange, and it's very similar to the VIX. And it's just showing how we really spiked up in 2021. Well, we've been coming down from a volatility standpoint. So they're not, as this comes down, they're seeing less and less risk. The closer you get to 100, that's less risky. The closer you get up to 200, that's more risk. So this has just been coming down lately. This is looking at housing, where you have privately owned housing, and these are the total number of units, and it's starting to decline. That's the kind of reddish line here. But is it really dropping the way it has before, typically when we start to enter into a recession? Okay, it's not really telling us much right now. The blue line are new one-family houses. It's also declining, but we saw just a little bit of a blip up here on this chart. I'm not really getting much from this chart. We can look back historically and say sometimes when this topped out and went down, we went into a recession. Sometimes there was a long lag between the two. Here's the screenshot that I was talking about, where we had large value up 0.48%, where growth was up 1.68%. And this is the area that I tend to focus on the most. I watch all of them, but this is more tied into the S&P 500. Here's the VIX showing that with the up day, we did decline on a closing basis and we closed near the bottom of the bar. So fear has really been subsiding. Also suggested in this chart with the VIX of the VIX, it's declining right now. And here's the RIDEX, the latest reading I could find, where we're seeing a drop off in those that are in the bearish funds. That means they're getting back into the bullish funds. So you have some of these folks that are getting a little more positive about the market. Here's the daily chart of the Ulcer Index, which shows that fear is very low. This is, in my opinion, a more valid representation where, yes, we're coming down on the weekly chart, but we're still showing fear rather high. And this lines up more with some of our other sentiment indicators. We're down 17.01% from the all-time high. You can see I try to update these lines every day here. The equity put call ratio, this is kind of interesting. It actually went up on an up day. Usually it goes down on an up day, but with the 5 period, we are still declining overall. This, just to go back, this shows you where we were at as of July 8th, that there was a 92.4% chance that we were going to raise interest rates 0.75% at the July 27th meeting. Then we got some economic reports that freaked everybody out. And as of Thursday, July 14th, it got back to being more even. And then this is where we're at as of our latest reading. Things are coming out a little weaker now. People are kind of calming down a little bit. Now they could freak out again. There's still a few days before the Fed starts to meet. So this could still gyrate around, but at least right now, it's showing that there's a 72% chance that there's going to be that 0.75% rate increase. All right, support and resistance. Here are the daily pivot levels intraday for the Friday session. Then here's the daily chart showing how we're coming up nicely right here. Can we get through this area, which this gap, when we really gap down? And you don't see a lot of gaps in the S&P. Because of the way things work and how the open is, a lot of times it will come very close to opening where the yesterday's close was, even if we quickly go up or down in that direction. So to see this gap is kind of strange. You see it on stocks all the time, and you see it all the time, and you see it with ETFs as well, but you don't see it as much with indexes. Can you see a lot of gaps in here? There are a few, but not as many as what you see with stocks. Here is the daily chart showing how we've been able to break above a little bit here with the DeMark pivots. So that's positive. Things are looking a lot better right now. And then we're getting up to some resistance right now on this chart, which is just a little bit over the 4,000 level, 4,019 or so. And we're at just below at 39.99 or so. Our different sectors, the discretionary, which has just been getting hammered in 2022, it was up the best. Healthcare, materials, technology, and real estate had pretty good days, where you had two sectors that were down: communication, and it's now gone into last place as far as performance since the all-time high, and energy was down too. There's a lot of people that got burned in this. A couple of weeks ago, everybody's blah, blah, energy great. Energy is just going to go to the moon. And so you get people that tend to follow what's going on in the market instead of trying to anticipate what's happening in the market. They get in and now they're seeing losses. I saw it with gold. You see it with .com. You see it with cryptos. It's how these things tend to work out for a lot of folks. Then here's the scooter score. We only have two that are above 90 right now. Energy and healthcare are looking pretty good. And we only have one, communication, because it's dropping a bit now. It is in last place. This is what I'm talking about with energy looking pretty good, but it's given up a lot of the gains. Utilities and all of the other sectors are now negative, and communication now switched into last place and bumped discretionary up one notch. Here are the indexes. They haven't changed. Well, I guess maybe they have. The S&P is showing some improvement, but we're watching the NASDAQ and the NASDAQ 100 right now. When things opened lower, I was constantly watching the NASDAQ during today's session. And I was watching it yesterday too. And I'm also watching the dollar. And the dollar was negative and the NASDAQ was still holding up pretty well. In fact, they were positive. And so I thought, okay, once we get this little selling out of the way, we're probably going to go higher. And I kept watching things, and that's what ended up happening. That's part of the intermarket analysis that we use intraday to really understand what's happening. That's why I keep saying, watch, 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 observe what's going on. That's how you can learn what's going on in the market. by just keeping an eye on things as much as you can. We didn't have very many technical alerts. Canada was a little bit negative, but then we had the NASDAQ above 11.9 and then above 12. The NASDAQ got above 32,000. Just some levels that people like to talk about. So, and I've tried to widen this out a little bit where we had a little bit of a lower open. We did blip up positive, and then we came down to S1. Well, that ended up being the low for the day. And then we shot all the way up to R1. Okay, and the cat's gonna say hello here. And we kind of danced along R1, but then going into the close, we actually went up a little bit and closed at the high, and we never did make it to R2. Then our trend, we're seeing the green line coming above now. So that's positive, but the ADX is still below 20 and the dark line is still below the moving average. Then the Arun is still just pegged to the top, because once we broke out of this sideways mess that we were in, the Arun picked that up, and that's why the buying is just pegged to the top. That means that buyers are in control, and we're seeing selling decrease. And so our oscillator, which had been negative for, it seems like forever, since way last spring, it finally went positive. Looking at breadth, these are the two 90% days that I'm talking about. That's what this blue line is right here. And that's looking pretty positive. And so can we see some follow through after we see action like that? Other times, no, we didn't see that. Other times, yes, we did. But we're seeing some improvement based on price and volume. The advanced decline ratio is still looking positive. This is the concern. See how we had the up days that we've been having? We're not really seeing a big increase in the new highs. Okay, now part of it is because we've been sideways for quite a while, but this is a little bit concerning. We just want to keep an eye on this. If we can break out, maybe get back more into this gap, are we going to see that generate some new highs? Conversely, if we start to break down, if we pull back, are the new lows going to really advance? Accumulation distribution. This is still looking positive and showing a lot of improvement. Here's some short-term charts. Whoops. Here's the decision point. This cat just, he knows that I'm doing a video, of course, you know, and so he has to be some kind of center of attention. So we've turned back positive with the trend model, with the decision point on the short term. Okay, we're dancing around here. The PMO continues to be positive, but intermediate and long term, we're either neutral to negative. The 20-day, we're well above the 20-day now. It's kind of nice to see that happening. Here's the rate of change going back 5 periods. This is looking a little extreme. We could still go higher from here, but we just want to be aware of this. The short-term rainbow, we're starting to break out above the rainbow. Haven't done that. My goodness, it was still winter, maybe early spring, the last time we did that. That run up that we had in March saw some improvement. Here shows the moving average tree where we're starting to get above the 50, and I have a chart of that to show you here in a minute. The stochastic RSI looking a little extreme. Williams percent R also extreme positive. The force index not extreme, but still advancing. The Swinland trading oscillator based on price, it's still looking okay, but based on volume, we're starting to get a little bit toppy. Now, to me, I see this as more positive. When we have prices going up and we see volume actually outpacing price as far as how it's performing, because it's the volume that shows us the real intensity of what is happening. The McClellan oscillator also starting to get a little toppy. The 20-period moving average actually turned down a little bit. That was a little bit surprising. The 50 is advancing and the 200 continues to advance. And I have this cat all over me making weird noises here. Short-term stochastics, extreme positive. Starting to get extreme positive with the intermediate term, still positive with the long term. 50-day moving average. It's kind of nice. We haven't really been above this with any kind of distance for a long time. Yeah, I guess you would go back to the run up that we had last May going into March, that went to the end of March. But we're above both moving averages. The PMO is still positive pretty much across the board. PMOs that are rising actually turned down a little bit after being extreme. That's also kind of positive. When the markets can work off some kind of topsy signal, or that we're overextended to the upside with price still going up, that can be positive. It can also be a signal that maybe there's some weakness under the surface that we need to be careful of. The PMOs that are giving buy signals still looking a little extreme, and those that are above zero continue to advance. Chaikin oscillator starting to get a little extreme, but it could still go higher. And the Chaikin money flow, after kind of defying things yesterday, well, it's showing some improvement again today. Volume, because we're seeing a little pickup, because volume on an average basis is starting to decline, we're seeing a little bit of improvement with our volume intensity measurement. The vortex is back to positive. Summation index based on price, positive. And here, where we're seeing volume really outpace price right now, which could be positive. And we have a blank screen. I'm not sure what that's supposed to be there. Here's our momentum oscillators. We're starting to look a little better with the slope, but all of the other oscillators continue to be positive. The BPI continues to show an advance. Ease of movement showing an advance. Ultimate oscillator starting to get extreme positive. Here's our intermediate term rainbow. We're still coming up into the underside of that rainbow. The CCI in 14 periods looking extreme, as is the 20. Money flow index still looking positive. We're coming into the underside of the Ichimoku cloud right now. Bollinger Bands also looking a little extreme positive. We're starting to get outside of the upper band right now. Here's the TTM squeeze. We're coming back up to this anchored moving average. That might provide some resistance. This goes back to the COVID low. It's different. This is a 50 period moving average, where the other moving average that I often show is a 20. Well, we've broken above the 20. And so I'm not showing that one right now. I'm showing this one because it could be resistance. And notice how it's right at the bottom of where this gap started. Our different charts, the Heikin Ashi looking positive, the Kegi positive, Renko drew in another box looking positive, 3-line break also looking positive. Nothing new on the point and figure chart, but this is looking better, and we have a possible top breakout happening. The Elder Impulse system for the S&P is positive, and we're coming right up to that 65 period moving average. We're a little bit above it with the SPY. SAR still looking positive now. We're turning back. We're actually generating a signal with the go, no-go system. So that is more positive. Our longer term charts. Here's our long-term rainbow, where we're just barely coming up into that one. We've got a long way to go to get to some of these longer moving averages. But the 50 is still advancing, as is the 150 and 200. Special K, still pretty much flat right now. It doesn't move all that much. The diamonds are breaking slightly above the moving average and are positive. Here's the Dow, also above the 50 period moving average. Can it stay above that? The Qs also looking positive and breaking out a little bit. NASDAQ 100 also breaking above resistance level here. The VIXN also continues to decline as the NASDAQ 100 advances. The NASDAQ itself is just about at R1 here on the monthly calculation. The mid caps also looking better. Now, one thing that, and I'll show this later, one thing that's a little disappointing right now, the small caps really underperformed on Thursday, but the Wilshire is looking a lot better. The dollar, it was down slightly, but it's still in an overall uptrend. Gold bounced up a little bit, but it's still in an overall downtrend, as is silver. Here's the S&P to the dollar. They are going in inverse directions right now. So if the dollar's going down, that can help stocks. And if the dollar's going up, that can hurt stocks. So you might want to keep an eye on the dollar index. Oil dropped a little bit more, down to 96. That might help gas prices a little bit. The correlation between S&P and oil still, well, we're getting back more towards neutral right now. When we're at 0.25 to minus 0.25, to me, that's the neutral area. Bonds, we're up 0.82% with the bond ETF, but we're still far from showing improvement. But could we be building a base here, just like on the next chart? Are we building some kind of a base as we continue to deal with the COVID low for bonds? Looking at the yield curves, the 10 to the 5 continues to be negative. The 10 to the 2 continues to be inverted. And the 10 to the 3 month continues to drop. So again, we will just want to keep an eye on this. The tech sector to the 10-year correlation back down to pretty much neutral now. We saw yields pretty much decline across the board, which is strange in a high inflationary environment with the Fed going to raise interest rates. How come yields are going down? Does the bond market know something here? I would suggest yes, but nothing is ever absolutely certain. So let's look at our scenarios. Now, this is longer term. This is the percent of stocks above their 200-day moving average. And this doesn't move as much. We need a lot more price movement than what we're seeing right now, but this is still holding up. This is the 10-day average of highs and lows. See how we actually dropped a little bit from yesterday's reading. That's a little bit of a concern. So I'll be watching that. The stocks that are above their 50, that's breaking out. Mid caps, they're breaking out. And small caps, even though they underperformed, they're still looking better. Here's the equity put call ratio longer term, where we're still coming down with our VIX. Why do I say VIX? With our equity put call ratio. Because they move in the same direction. Here's the small caps, and they were up only 0.28%. You had the S&P up almost 1%. The NASDAQ even more than that. So the small caps really underperformed. The ratio actually declined a little bit because the S&P did better. And we're still seeing a little bit of a breakout here, even though it has declined in this red chart. That could really give some support to the S&P. And here's the S&P against the 10-year yield, also getting closer down to the neutral level. Here's the S&P against the 2-year yield. They're kind of going in the same direction, but dropping back a little bit. The Copic curve starting to rejuvenate that signal as we're going up. Apparently, that's what the Copic curve was picking up. And as we go higher, it continues to like that. The praying bottom fish are rolling up, rolling over a little bit, but still giving us a signal. And here is our sector rotation. The Qs are going up, the discretionary is going up against the S&P, and growth is starting to go up against value. And here's some more growth and value charts with the large caps. Here's the mid caps and then the small caps. 2-year spike. Haven't shown this one in a few days because it looked like we were spiking up again. Well, we're not really coming down off of that spike currently. This is also another concern. We have the staple sector giving us a death cross. The blue moving average is now moved below the 200-day moving average. And there's just kind of a conglomeration of price right here. Are we going to fall from there? And then this just shows how the staples have really been going down. So this is right now looking like a valid spike. Can we see more follow through with price? Other times, this was a really good signal. We just want to make sure we're getting the spike right. So what's our outlook then for Friday? The technicals, they continue to improve and they're turning positive. Sentiment is also improving. We're getting closer to being neutral again. We have the preliminary IHS market manufacturing and services PMI. Those are two separate reports. I just crammed them into one sentence here. They're not biggies. There are PMI reports that are big. It's not this one. Now, if something really, really wacko happens in one of these reports, yeah, the market may react to it, but typically it doesn't. All the geopolitical events. And I was getting ready to take Italy off of here. And so I did a quick Google search only to find out that now their prime minister has resigned again. So they're still having some real instability in Italy. And then all of the other reasons that I seem to cover all the time. So our scenarios down, all of these headwinds that are listed right here, this could come to the forefront and push prices lower. Also, the fact that we might be short-term overextended. Now, we still have more room to run upward. but that might produce more of at least a short-term overbought condition. So we just have to see how things play out. If we can see more correction within some of our indicators with the price not necessarily going down, that could end up being positive. How can we go up from here? Technicals, they're looking a lot better. They're turning positive. And you still have a lot of folks that say, no, the market's never, ever going to go higher ever again. And that's usually when it does. Our scenarios still looking good. Our sector rotation still looking good. Our positive setups, they're looking pretty good right now. We have to be respectful though, because we've been fooled before in 2022. So if you use stop losses, if you even mental stop losses, you want to make sure that you're right on top of those if you can be. The technicals, we're getting above some moving averages now, so that's looking a little bit better. We have some overhead resistance, but we're still maintaining support. And then other levels may provide either support or resistance. The highs, the lows, maybe from last week, maybe in that gap that we're trying to fill if we can. We are technically sideways now because the ADX is below 20 and it is positive. So our conclusion is the S&P is improving. Can it continue? Short term, all I can say is improving here because, yeah, it's positive, but at the same time, we really need to be careful in this kind of an environment, not to take anything for granted. So thank you. I hope everybody has a wonderful Friday. I will look at preparing the video for Monday over the weekend. Now, the last couple of times I said there might be a delay, and then I did them actually earlier than usual. I do those as I can. So I'll post that without driving myself too crazy by looking at charts all the time. So have a very good Friday.